My favorite way for a new stock to get into the portfolio is that it's not that you have something on your portfolio that something is going wrong, but it's genuine competition for capital. That's what actually got us really excited to come to work every morning. If you just do it better, plan it better, move faster than your competitors, then you sort of grab an extra market share and have something to build on as the market open up again. When you actually have a management team that have a real vision, that have a real plan, and then just keep their heads down and ruthlessly execute on that plan, all of a sudden that growth rate actually go from 15, maybe to 12 1 year, and to 18, 25, 30. What we are observing is it almost doesn't matter which industry you're in, the embracing of the digital strategy, that really needed to be a seed that planted years before COVID. Earnings seasons have been very fascinating this time, and we actually just wrapped up as of last week. Our team just had our own debriefing. I think two things really stood out to us. One is the real demarcation between the best-in-class companies and their own industry and their own country GDP. So one of the classic example is, some of you have read the headlines, the Indian GDP for the second quarter declined something shocking, over 20%. And then the private banks themselves as the industry has also seen noticeable decline, and HDFC grew double digit. Really, this is one of the most dramatic differences in performances of the good companies, their own industry, and the country. But this really sort of reaffirmed our belief, like when we think about allocating capital to the Asian market, we're not really thinking about country GDP growth, industry growth, and maybe the companies would do a little bit better than country or industry GDP. We're really looking for that best-in-class manager, best-in-class companies, and we think their long-term growth rate, and this time it just proved again, that's the correct trajectory. The long-term growth rate should have nothing to do with the industry itself. So that's really exciting to us. And then I would say sort of the second one is, we've also had, we were just doing the stats out of the top 10 positions of the portfolio, 7 or 8 of them clearly beat expectations. And not only that, they're actually guiding the second half of the calendar year 2020 back to the originally expected growth trajectory that they were planning back in, year end 2019. So, really, I think the best companies at this point are probably back to the original plan and really sail through this. Inventory is clean, customers continue to be sticky, supply chains have been taken care of. So that's been really good to see across different Asian markets.
And Qiao, in terms of valuations, you've referenced 6 or 7 of your top 10 positions, yep, resuming pre-COVID trajectory. That's obviously from a fundamentals perspective, that's a great result for those companies. What are you seeing in terms of valuations? Are these high quality performers? Are they starting to get crowded?
You know what? That's the fascinating part, and that's what actually got us really excited to come to work every morning. So across the portfolio, even after the fairly big run of stock prices after these companies bid, so the stock runs are probably fairly justified. Across the portfolio, we're talking about a 22 times price to earnings for probably the next 5 years of growth CAGR of 13 to 14%. And then an additional interesting status, we look at across our 40 companies, the long-term ROE is over 15%. So this is really a group of awesome high quality companies that generate great return of capital, have an interesting double-digit growth rate, yet trading at, call it low 20s of earnings, and probably call it 26, 27 times free cash flow. So to us, that is still incredibly attractive. And one of the reasons is precisely sort of tied back to my earlier point that the markets are still viewing a lot of these companies as, living in a volatile market, in a volatile country, therefore giving you some kind of discount and sort of not quite taking into consideration that their fundamental performance have really surpassed, the usual industry and country norm by a country mile.
So the top 10 sounds like it's done okay for you. What changes have you made to the portfolio over the course of the 6 months, or I guess 9 months that we're into this year now? Have you made some material changes?
Yeah, so the portfolio has a long-term, very low turnover stat of roughly 20 to 25% every year. So by any standard, this is a very low turnover portfolio. But in times like this, we do see attractive opportunities, especially on some of these companies that we've been tracking for a long time. So out of the 40 companies we have in the portfolio, we have roughly 9 new ideas that got introduced into the portfolio over the past 10 months. And then, of course, the sizes of these portfolios is small. So together, they're still within that long-term turnover percentage ratio for the fund. But that really introduced a lot of fresh air into the portfolio. So when we look at the bottom 10 position ranked by sizes of the portfolio, now 7 of them are actually new ideas, which is exactly what you want to be. You don't want the bottom rank to be the deadbeat ideas that you have low conviction. You want it to be the new ideas you're working up the sizes over time.
We might come back to that position sizing and managing new ideas in a little bit. I just want to stay with the companies that your core holdings, your top 10, the bigger positions in the portfolio that are more established and have been proving quite resilient by the sounds of it. What are some clearly identifiable traits in those stocks? And maybe you can give me a couple of examples that you think are setting those apart from some of the other companies that are not performing so well or proving to be vulnerable.
Yeah, I mean, the 2 trends that we have observed, which actually stood out pretty clearly across these companies, and the top 10, they're not just in tech or consumer, they're really across tech, consumer, healthcare, and quite a bit of the retail as well. And what we are observing, and a few insurance companies, believe it or not. So, what we are observing is it almost doesn't matter which industry you're in, the embracing of the digital strategy, that really needed to be a seed that planted years before COVID. So when COVID hit, of course, all the sales were driven online, no matter which industry you're in, because the offline shops were completely shut. So the online sales percentage of total is almost meaningless. To us, what's a lot more meaningful is what kind of infrastructure, what kind of team structure, and within the organization you've actually made. And most likely these changes were made way before COVID and just get accelerated over the COVID period. So one of the great examples is AIA. So AIA, which a lot of people know, this is a Pan-Asian most prominent life insurance company. And one of the things that really help AIA, and the headline for insurance industry actually sounded very challenging. Low interest rate, the borders are closed, so the Asian consumers can't really fly in and out of these more tax advantageous regions like Hong Kong and Singapore to buy policy. So, and then in the domestic markets, the agents can't go on the street and meet with customers. So everything about the insurance company should actually make you think they're very challenged. But what they actually implemented was the first time in the company, they actually have an end-to-end training, closing deals, the entire insurance sale process on the digital platform. But in order for that to happen, first of all, they already implemented the system probably 6 to 9 months before COVID hit. They didn't know about COVID, of course, but that was just part of the long-term strategy planning. And they even hired a new CEO from Ping An, which probably had the world-leading technology for insurance, just to ramp up within AIA, the insurance system building. So all these things really came helping them. And then, of course, sort of continue to put the foot on the gas throughout COVID instead of retreating and laying off and furloughing your agents. That also helped tremendously. So we think they're actually very well positioned as the markets recover to really come out and grab even a larger share of the market. So that's sort of one of the things that we observe. And then, of course, the second one, which we talked quite a bit over the past few months, is really the culture of the company, the resilience, the hardworkingness, the not being completely blindsided by fear and just push through. And make the proper planning. And in a lot of ways, this is not an absolute game. This is a relative game. If you just do it better, plan it better, move faster than your competitors, then you sort of grab an extra market share and have something to build on as the market open up again.
But you've talked about wanting to own best in class or, the best house in the worst postcode.
Yeah.
And you think that, I think the quarterly said, you think that's setting up a great opportunity for the next 3 to 5 years, like a good medium-term opportunity for you. Can you talk me through that concept and how you're approaching it?
Sure. So I can give you two examples, and they're both related, and they're both in the sportswear industry, which is quite interesting. So the first example is the manufacturing of sportswear. So again, when you take a step back and think about any type of manufacturing during COVID, just sounds like an absolute nightmare. Densely populated workers in a confined space, which means you probably need 15 different government permits before you can even reopen your factory. Your supply chain is all over the place because your suppliers' trucks were nowhere to be found. Your own truck drivers are probably living 3 provinces away, which cannot, may or may not be able to come back to work. In addition, you also have a lot of the materials coming from overseas, and then the ships and the trucks and the whole different transportation challenge over there. So, naturally when COVID hit, the entire manufacturing space got hit very hard. And we actually added to one of our core positions, which is Shenzhou. And this is a Chinese manufacturing company that really make most of the products for Nike, Adidas, and Uniqlo. And this is sportswear, not necessarily shoes. So back to the point of the companies actually taking steps to prepare for something like this way before COVID even hit. So the founder of Shenzhou actually had the foresight of building out vertically integrated supply chain in Vietnam and Cambodia. And by vertically integrated, I meant the fabric actually come from local Vietnamese sources. So they don't need to wait for the fabric to come from China for the Vietnamese factory to open up and cut. And then of course, during COVID, when all these borders really start closing, their factories became the only ones that's actually functional and capable to produce. So if you are Nike and Adidas, and then you want to actually you want a lot of additional flexibility from your own supply chain because you don't know where your own demands are. All of a sudden, some of your suppliers are telling you, I may or may not be able to ship it to you, at this date. And Shenzhou is telling you, I can guarantee shipment on a monthly basis. Actually, I will even shorten the production cycle for you. Therefore, it's a lot easier for you to predict your own demand. Which one are you going to give more orders to? And which one are you going to build better relationship with? So these kind of loyalty with your customers and working more closely with your customers is going to carry them for years to come. It's not going to be sort of a COVID, I work with Shenzhou, after that I go back to those suppliers. First of all, we don't even know if the other suppliers still stay in business. And secondly, it's just naturally you're going to become just a much more important partner for the supply chain. So that's one of the example, I would say, the best housing in a terrible postcode.
Can I get you to give viewers a bit of context? Like, what's the market cap on that stock? And if it's, if it's not a one of the kind of the fantasy or the high flyers or the darling stocks in the region, can you talk me through some of the valuation multiples that for that company, just so people can get a context of what you're talking about?
Sure. So it's actually a substantial market cap company. I think market cap after the recent run probably should be. Let me just double check and make sure I give you the right answer. Yeah, so now it's 24 billion US of a market cap. And the additionally interesting about this company is still trading at less than 30 times free cash flow. Now, in the past, the company is treated as a cyclical industry, and then your market share from your major customers is always uncertain. But after COVID, the additionally interesting thing is all of a sudden your market share gain become a much more certain outcome. Therefore, if you think about sportswear or Nike and Adidas can grow high single digit, low double digit for their own customer, for their own sales, then Shenzhou could actually take up a lot of market share within that. So you can really see Shenzhou growing, call it 15 to 20% in terms of free cash flow, and then trading a 30 times free cash flow, even after, a massive run recently, is still very reasonable. So these are really significant companies with significant market cap and a real professional management team. And then we think the market cap is on the way from 20 to 35 or 40.
Qiao, I want to go from some of these lesser known opportunities and talk about a trend that we've seen not just in Asia but globally, where these market leaders, the dominant companies, have become more dominant. I read a great example. Someone said you could have followed Warren Buffett into Apple, hardly a secret, and doubled your money in 2 years. And it's this argument that these big market leaders potentially always look expensive and you always feel that you've missed out. And I know at Cooper Investors, you have this concept of value latency, and we discussed it last week, and you talked about it as something that you look for in companies as a way of management unlock and add additional value, but you can't actually see it or measure it on a balance sheet. So I was hoping you could talk me through the concept of value latency, and specifically, how does it create additional value? Like, what's the concept? What are you looking for there?
Yeah, sure. So value latency is really a concept. It's a bedrock of how we invest at Cooper Investors. And we don't call ourselves value investing because I think value investing lately has been really equated to low PE investing, which to us is uninsightful and uncreative. So value latency is basically saying when you have a great management team that build a very great culture, think about the simple things that they do that's differently day to day from their competitors. That's not necessarily being captured, definitely not in the historical financials, but most likely not in the forward forecast for most analysts as well. So, in the most of the times when we model a company, we usually say, okay, historically, you've been growing 15%. Going forward, probably steadily, you're going to grow 8 to 10%. And then if you have some interesting additional new product, maybe that will accelerate 1 to 2 points more. And this is really sort of a classic way of thinking things reverting to the mean. But when you actually have a management team that have a real vision, that have a real plan, and then just keep their heads down and ruthlessly execute on that plan, all of a sudden that growth rate actually go from 15, maybe to 12 1 year, and to 18, 25, 30. And then because they just create this massively new revenue stream that no one saw it coming, probably they themselves didn't even know how successful they were going to be. So if an investor just go back and really measure a company on the historical financial of historical earnings and free cash flow, you're missing out on all these intangible qualities of a company. So Tencent is a great example of that. From the founding of the company back in 1999 till now, Tencent has changed probably 5 times into completely unrecognized companies. So if I show you a Tencent income statement in 99 versus income statement in 2002, 2005, 2008, and now 2010 and 2018, you're going to think these are 5 completely different companies that have nothing to do with each other. Even the revenue labels have changed. So, all these massive changes within the company, you simply cannot capture if you just look at sort of a simple historical financials. So that's sort of the first one. The second one of latency is even more subtle than that. So let me just ask you a question. How do you put on a spreadsheet how do you quantify and put a value dollar number on the fact that some companies' employees stay and work in a motivated way until 9 p.m. versus some people's employees are out of the door at 5 o'clock straight? How do you actually quantify that? But to us, that's hugely value add, whether or not you actually have motivating workforce that work much harder than the competitors, that were compensated appropriately, that have really clear KPIs. So all these things we take into consideration when we actually value a company. And when we look at the total valuation, we basically said, if we do our really boring, uncreative financial numbers crunching, basically the consensus number, and that's roughly where the stock is at right now. But we have all these additional intangible qualities that we know, management is talking to all these strategic initiatives. We know their store managers are actually staying 5 hours more a week to actually do inventory, to put everything on digital, everything on the system properly. We basically say there's a lot of latencies that's not being captured by the existing stock price. So, it's a bit of an interesting concept that takes a while. Usually people getting Cooper Investors takes about 12 months to finally sort of grasp that latency concept. But to put in simple words, that would be how I explain this.
Can you just talk me through how you're managing new idea, position sizing, and sort of that life cycle of a company? I think everyone can see the top positions. They read the reports. They can see your big holdings, and often they stay there for a long time. Talk me through the genesis of a new idea, how it makes its way into the portfolio, and how you manage that through.
Yeah, so new ideas getting into the portfolio is an incredibly important research tool for a portfolio manager, not just for the new ideas making their own P&L. Of course, that's important, but also just keep you on your toes, on the ball, always fresh for the whole portfolio, because often this come in a related industry that really get you to think about your top holdings in a different way. So the way we manage our new ideas pipeline is we usually have, call it 110, 120 stocks that the team track very, very carefully. And we do just as much work on these 120 stocks as we would on the 40 portfolio stocks. So we travel to see management when we could. Now we do video with them, probably 4 to 5 times a year, these type of one-on-one video interaction. We updated all our models. We do, every single bit of the channel work that we possibly could on them. And, usually every year, the market would give us an incredible opportunity that you just know the value latencies on 10 or 15 of them become so appealing. And then that's really where, we pounce at the opportunity and then we make them into the portfolio. So by the time they make it into the portfolio, we'll most likely have tracked them for 1 to 2 years, probably closer to 2 years. So we know the management team already very well, but from a risk management perspective, most likely they still come in at the beginner size, which is roughly 100 bips, 1% position, give or take. And then sort of as time goes, we continue to build our own conviction into the portfolio. Or if the stock falls further, that we think the latency become even more appealing, we give us a lot of room to add. So that's sort of a simple rule of thumb. We're not as sophisticated as some of the computer programming that really calculated the ideal new position size, but this is sort of roughly how we think about it.
And for a stock to make it into the portfolio, if you're roughly running 40 positions, it means something has to come out.
Yes. That's actually my favorite way for a new stock to get into the portfolio, is that it's not that you have something on your portfolio that something is going wrong, but it's genuine competition for capital. You have an analyst come to a portfolio manager that basically say, hey, I have this awesome idea that I think has much higher risk adjusted returns than this other idea on your portfolio. I mean, this is absolute music to any portfolio manager's ears.
Now, Qiao, I want to wrap up with, just to get a sense on how the portfolio is positioned in terms of a conservative, bullish, bearish, like what's the current stance? I know, looking back on a few reports, you were close to your max cash level, which is 10%. You're up around 9%. How are you positioned right now? How have you set the portfolio?
Yeah, so our cash position is roughly between 5 to 6%. So I would say somewhere in the middle. So we have some dry powder to really sort of add if some of the positions that we like have a significant fall. But at the same time, sort of we're pretty close to fully invested. I like to tell my investors in a really simple way, I feel very uncertain about the world, but I love our portfolio. And that's genuinely how we feel, to have a portfolio of high quality stocks backed by 40 teams that we've all visited multiple times, know their faces, we sleep incredibly well at night. And then to know that this portfolio overall is trading at 22 times earnings, give us that extra layer of sense of security in a lot of ways.
Well, it's been great to catch up as always, and some really interesting stories there on a number of companies in the region that I'm sure people are not so familiar with. So thanks very much for taking the time to give us an in-depth story.
Thank you for having me again.